If you read about negative interest rates in the financial press, you might have been wondering what the heck is going on. Why would there ever be a negative interest rate? After all, if you lend money to someone, you're going to charge them 5%, 8%, 2%, something like that. You're not going to say, I'll take a return of negative 3%. That's essentially saying that you, as the lender, are paying the borrower to take the money. You're like, look, I don't need to earn a rate of return. In fact, I'll accept less money from you. Just take these funds. Okay. Now, you're normally not going to see a negative interest rate with the nominal interest rate in real life. What you're more likely to see is a negative interest rate when we're talking about the real interest rate. Okay, the real interest rate is when we take the interest rate, the nominal interest rate, and then we adjust it for inflation. So in this example, we've got a nominal interest rate of 2% being charged on some type of security, but the inflation rate happens to be 3%. So when we think about the interest rate after accounting for inflation, okay, 2% minus 3%, there is a real interest rate after accounting for inflation of negative 1%. So that's where you're most likely to see this concept of negative interest rates, to see a negative real interest rate. But it still raises the question of how could we have this situation where anyone would accept, whether it be real or nominal, how would we ever come to have an actual negative interest rate in practice? Okay, and there are a couple of reasons why you might see this. One is monetary policy. You basically have a central bank that is trying to stimulate investment. So the central bank is maintaining a negative interest rate. They're basically paying commercial banks to take money and lend it out to businesses and individuals. So they're trying to stimulate investment in the economy. The European Central Bank did this for years as a policy tool. Okay, so the central bank is saying, listen, we'll maintain a negative interest rate, because then banks are going to say, oh, you'll pay us to take money? Okay, great. But then they take the money and then they lend it out. That lending leads to additional investment in the economy. Businesses get the money that was lent to them by banks, and then they go buy equipment and so forth. So it's intended to help stimulate the economy. Now, another situation where you could see a negative interest rate would be flight to quality when there's a market downturn. So if we have a recession, sometimes in a recession, investors might say, look, instead of just holding cash, I actually think it would be safer to hold government securities, right? So government securities, even though they have a negative return, the investors might perceive those government securities like treasury bills or something, short-term treasury bills, they might perceive them to be safer than simply holding on to cash. So in that case, they would be willing to accept a negative real interest rate because they don't want to be caught holding cash. They'd rather have something that they perceive to be even safer investment.